Mr. Ahuja, thank you so much for taking time out and speaking with us on 80 Now.
Thank you so much for having me here, talking to you.
How much do you think RBL Bank can help investors reap in the coming 5 years? You spoke about long-term gains, and clearly if you look at your business model, you have a niche, not just in the agricultural segment, but the overall business has a very unique plan. How do you want to leverage on this, and as an investor, what kind of returns could they expect from RBL Bank in the coming 5 years or so?
The way we've stacked up our strategy is on a universal banking platform. We are into the various segments of the economy. We deal with large corporates, we deal with mid corporates, SMEs, and then further down into the retail products, and again more strategically into the financial inclusion agri ecosystem. So, and more recently, in the last 2 or 3 years, I think we are emerging as one of the finer new age banks, which are moving very rapidly towards the digital banking opportunities, etc., and in terms of partnerships with fintech world in a very big way. So all of these segments we straddle, and we see growth opportunities in many of them. So if I have to put it this way, I think we got our spot right in terms of looking at the 3-4 growth segments, and we've got a good positioning in each of those spaces. And let me be a little more specific. So we were one of the early banks which felt that there was treasure at the lower end of the pyramid, and financial inclusion became a very big opportunity area for us. Over now 6.5 years, we've built a great, if I may say, business model there. And that is growing extremely well and continues to do well for us, despite some of the distractions, post demonetization, etc. I think that was an 8-9 month aberration, but fortunately we were able to ride it out quite effectively and much better than some of the other players in the industry, and once again it's on a roll. Similarly, our corporate businesses are doing extremely well, and on the retail side also we've created certain niches, as you very rightly mentioned, both in terms of how we garner liabilities and grow that franchise, and at the same time on the asset side, we've been very judicious. At the same time, we've picked our spots. So cards is one area where actually we've identified that as a very underpenetrated but high growth opportunity, and both directly and through our very effective partnership with Bajaj Financial Services, which is doing extremely well in a short period of time. We are very hopeful that that will become one of the serious and high growth engines of the bank going forward.
You also aim to be among the top 5 in the credit card space.
And that is already within sight. We are already reaching number 9 and 10 in the space of few months, 8 or 9 months. So therefore, and the rate at which we are growing, if I just tell you, we are the 4th or the 5th highest, if I may say, bank in terms of new customer addition in the card space. And actually all the others are very big banks and players. So in that sense, and also in terms of the spends, our card is seeing the 4th highest spends of any bank in the business.
I was just coming to that, Mr. Ahuja. You have managed to clock in about 35% CAGR on average. Do you think that your margins will only improve going forward, considering that you're also looking to change your loan mix a bit? You're moving more towards the non-wholesale side. Is this another trigger that will help you perhaps compound your growth rate as well as improve your margins, say in the next 5 years?
We have indicated a 30 to 35% sort of growth year on year. We have actually suggested that our return ratios will improve consistently every year, either in terms of ROA, in terms of cost income ratio, and some of the other parameters that go with it. We have also suggested that our sort of liability mix will improve, our CASA will go up steadily, and in terms of asset mix, the question that you mentioned, that we've started from essentially being almost entirely wholesale 5-6 years ago, and today we are 40% non-wholesale, and the idea is to go to 50% non-wholesale by 2020, so that we have an equal mix of corporate and retail in the portfolio. What that does is, with the improvements happening on the liability side and with the better asset mix towards high yielding assets, and provided we manage our asset quality well, then certainly our operating margins and both in terms of NIMs and ROAs, you should see improvement happening.
You have bucked the trend, so to say, if you were to compare it with peers in the private sector banking space. But in the prevailing backdrop, we have had hiccups from demonetization, GST. You did manage to stride through these.
Yes.
But more importantly, going forward, what is your outlook on credit growth and also on margins? The reason I ask you this is because we aren't seeing too much demand coming from the wholesale side. We aren't seeing green shoots yet. In fact, the IIP number released yesterday came in low at 2.2% once again. In the given situation, how do you evaluate the roadmap ahead?
So yes, we, for various reasons, we continue to see a good growth momentum in our various businesses. We expect actually all our businesses to grow well. Now, surely some businesses will grow faster than the others. And I think the businesses that we expect to grow faster will be the financial inclusion business, the retail lending business, essentially, and the digital acquisitions that we are making, working with partners. Okay, so these are the three spaces. On the corporate side, we will see steady growth happening. We are more confident on the mid-corporates and the SME space, where we will perhaps expect to see even faster growth. That was one high-risk area in the past. I think we fine-tuned our business model extremely well. And today we are confident that that segment, there is a lot of untapped credit demand sitting there. And with various things happening in the country, which are bringing in more prudence in the way you can lend to some of these companies, we are hopeful that even that will grow. If I may sort of cut to the chase, I think on the lower side, the corporate segment should grow at 20% plus. And on the higher side, some of our, if I may say, financial inclusion and retail businesses should grow at 35-40%. And if you take on balance, it will sort of average out to that 30-35%, annual growth of business that, we talked about earlier, and which is also part of our guidance. And so this is on the base that we have now. Our last 5-year, growth has been averaging around 48%. So obviously now on a much higher base, even this level of growth should be, fairly satisfying in a sense.
You did see some signs of stress last quarter, also this quarter, as far as the MFI book is concerned.
Sure.
This was partly due to demonetization. Going forward, do you expect the pain to continue, or do you think it peaked last quarter?
So the pain has peaked, but the residual effects of that are continuing. For instance, this entire sort of stressed portfolio has to be provided for. And the entire provision cycle will be 2 years. Some of it we have taken in this year, and some will continue into the next year. But having said that, we've factored all of that in. And it's not going to further disturb our numbers, either our gross NPA numbers or our, net NPA numbers or our profitability. So all I'm saying is that we have factored that in. And when it happened, obviously the next 2 or 3 quarters, which is the last couple of quarters and this quarter, that pain has to be first recognized. And I think we have recognized that to a very large extent. The new lending that we have done in this space, starting say January or February this year, 2017, almost 2,000 crores new lending, is operating at a 99% plus recovery rate. Okay, so the point being made is that in a sense it is back to business as usual in this space, and it is sort of picking up and lifting quite nicely.
To what extent have these been provided for?
So on the average, the first round of provisioning was around 25 to 30%. And then, see now the net effect of that on our portfolio is not very high, because again we have indicated that overall it's a 2-2.25% impact from a provisioning point of view. Because the nuance is that when we structure these facilities, we take first loss guarantees from our BC partners. And to a large extent, that covers the pain that we have to take. So the net effect on the bank, actually, as we have calculated, is about 2% odd. Yeah? And that we have factored into our business model itself. So it's not going to get worse than that. We have managed to contain it within that range in the first year between the 2 to 4% range, and going forward in around the 2% range. And even despite that, we end up with a 3.5% plus ROA in this business, despite that. So the point I'm making is, and it's about 4,000 crores or less than that, on a 40,000 crore approximately potential balance sheet size. So 3-4% on 10% is a net effect of 0.4%. It's well factored into the overall calculations. So honestly, this is a high growth, high opportunity area for us now. And all the new lending that we're doing and growing at 40% should further mitigate the net impact of that.
Sticking with asset quality, you are one of the few banks to not have any legacy issues as far as many of these big ticket accounts is concerned. Do you find yourself in an advantageous situation when it now comes to tapping in demand in this area? Fair enough, we are not seeing demand come in at this point, but we do expect credit growth to revive in the wholesale segment. What's your outlook on credit cost going forward, and how do you place yourself with your peers in the private sector lending space?
Certainly, we see growth opportunity even if credit demand is relatively soft. As I said, a 20% growth number in this space, we feel extremely confident of, and it can be perhaps bettered, and we'll see how it goes. So we've been tracking to an average of 30% plus in this space. And we do hope that we'll be able to maintain the robust growth in the corporate space.
Would you be able to contain your credit costs at this point?
Yes, certainly. We have actually, in our corporate space, our credit costs have been very well managed. And just to get more granular, our corporate business has not seen even gross NPA levels beyond 1.1, 1.2%, even through this very difficult period. And actually going forward, I'm confident they'll come down further. And so the credit costs will come down.
Any target you have in mind?
So for the bank as a whole, we expect credit costs to be in the 60 to 65 basis points range for the bank as a whole, but that includes retail. And as I said, in the retail products, the credit costs will be higher. On the wholesale side, the credit costs will be relatively lower.
I want to talk to you about your retail book. Retail has been driving growth for many lenders for the past couple of quarters. As far as the retail book is concerned, what will be your strategy to differentiate RBL Bank in this space? I know you have a lot of digital partnerships going for you. So as far as branch expansion is concerned, as far as digital forays are concerned, what will be the balance, and how will you really differentiate your offerings in this very competitive space?
Our approach to retail is to create a pan-India, multi-layered distribution structure. Okay. Direct physical branches is only one part of it, but while we will continue to grow branches at a reasonable rate, we add about 30 to 40 branches a year. It's not very aggressive, but it's the partnership-led distribution, if I may say, architecture that we are creating that is much more important in our strategy. So we have partnerships at two layers. One is dedicated, exclusive corporate BC partners. Today, we have about 10 of them, and one of which we own. Swadhar is a captive, and there are about 8 others. Through them, we have about 700 additional branches or banking outlets. So we have 240 branches of our own. We have another 700 through the BC partnerships. And further under them, we have other customer service points or points of sale, which are small retail points largely in the semi-urban rural hinterland of India, which are activated not for loans, but essentially for basic services, which could be micro payments, cash in, cash out, some savings products, etc. So these so-called Kirana stores or retail points are all activated by our micro ATM or POS machine, and can therefore enable and facilitate other banking transactions. So in this distribution architecture, we have today about 80,000 of them. So this gives me a multi-layered distribution structure to reach out from a customer acquisition perspective, and then layer in more and more services. That's one part. Much of this is now digitally activated.
So, with the expected improvement in your CASA ratio, what is your outlook on your margins? What kind of impact will it have?
So margins have been steadily improving, literally not just every year, almost every quarter or so. And we have reached almost 3.7% in terms of our NIMs, which was 3.3 last year, it was 3 the previous year, and so on and so forth. So actually we are getting into now the territory between 3.5 to 4 is the so-called very satisfactory market benchmark and an acceptable level of NIMs. And I think we are pretty much there. They may be based on our achieving better economies of scale as we grow as a bank, with slightly better CASA and slightly better asset mix that we will achieve. There is a little more room for further improvement.
By how many basis points?
Can't say. There is always a balance between growth and margins. Yeah. So honestly, there can be more than one view on the subject. I carry the view that if I stay between 3.5, 3.6 to 3.9 or 4%, and I'm getting better growth, I will sacrifice 10 basis points of margin for the higher growth, because despite that also I'm getting high quality profitable growth.
What's the trajectory as far as the other income and core income is concerned?
It's always been 30% plus. It's always been very high quality and and fairly sizable. And we have already sort of reached the 35% number. So again, between 35 to 40%, we want to maintain it in that range. And if you're able to maintain it in that range, with a 3.6, 3.7, 3.8 NIM, I think we are in very good shape in terms of delivering ultimately closer to 1.5% ROA. And that's the whole game plan. We are now, the whole idea is to take each of those decisions and strategies to escape velocity and then drive the benefits of that.
You raised funds via QIP recently. Any more capital raising plans on board?
So one philosophy of the bank has been to always remain extremely well capitalized. And we actually have been raising money little ahead of time. We've done it now for 5 rounds of capital raising. Starting 2011, we've done 5 rounds of capital raising. So the whole idea has been that, always keep a capital buffer and a capital cushion, because, you can never time the market perfectly, and also the environment can become unpredictable from time to time. That's one. 2, we have a lot of growth happening in the bank. We are consuming almost 50 basis points of capital every quarter. That's almost 2% every year. So actually, if you just go by that paradigm, we raise capital, we go up to around 16%, and then we drop to closer to 12%, we
bring it up to 16%.
Whatever, yeah, in that 15%. We are completely sort of adequately capitalized, and the need to look at any further capital raise perhaps may happen after that. So we are good for the time being. We are in good shape for the time being, unless some acquisition comes up.
And you spoke about acquisitions yourself, and the fact that you are thinking about it clearly tells me that there are several options that you could be evaluating right now. Now, I know you'll tell me it all depends on whether it's a strategic fit and how it really blends into your business model. But are you seriously evaluating business?
We don't have a single transaction on the table at this moment. We're not evaluating anything right now. But we do believe that we are at that cusp now as an institution, when you take all factors together, and when we see the opportunities sitting out there, we do believe that for a bank like ours, which is the most important thing, is that we have tremendous management bandwidth. Yeah, one thing that I think we did smartly, and I say it myself, is that we built such a deep and strong management bandwidth here, which can actually run a bank 5 times this size. Therefore, if a suitable opportunity comes up, there's no reason why we should not look at it. I don't
What
think anybody will
would
argue.
you call a suitable opportunity? Would it necessarily be in the banking space, or could it be in insurance or housing finance? As you highlighted that these are some white spaces where you haven't really entered. So what would a suitable opportunity for RBL Bank be in terms of acquisition?
So at this moment, we are looking at banking in general, financial inclusion in particular, and perhaps on the housing side, housing finance side. You're not clear. I'll be very upfront on this. This bank has no promoter. Let's understand that. It is a very unique model where it's truly a board and governance driven bank. The board is all very esteemed people of great professional stature, each and every one of them.
Corporate governance is something which RBL Bank is always spot on with.
Absolutely.
And this is something...
We have all independent directors, on the board. So, because there is no promoter, the entire governance responsibility therefore sits with the board and the management. And on that score, we want to be impeccable. I want to say that again and again. So that DNA of the bank, of being thoroughly professional, of having high governance standards. So that's the DNA of the bank. Now opportunities will come, we'll look at them.
Mr. Ahuja, thank you so much for your time. I have a feeling that I'll be speaking with you very soon, maybe on the next big acquisition that you've set your eyes on. Till then, all the best for the road ahead, and thank you so much for talking with ET Now.
Thank you, Neha. It's been wonderful.